All right, so welcome everyone. Today we have a special episode with two fantastic guests who are experts in their field. And together we're going to debate and compare asset classes. So it's not just me talking about stocks. We're going to mix things up a little bit. And so namely, we're going to be comparing stocks, commercial property, and residential property. Now, I know there's other debates going on right now, so I thought let's have our own debate and in something that really matters. And so I promise there'll be much more sense over here compared to the politicians that we have to listen to. Natasha Collins is our expert in commercial property and will be arguing the case for commercial property. So Natasha is a chartered surveyor and CEO of NC Real Estate, which is a firm of surveyors that specializes in supporting property investors to build commercial and mixed-use property portfolios in the UK, and her strengths are in asset management. And Natasha is also a property investor. She has a property portfolio consisting of commercial Resi and SAs in the UK and the US. And she's also a stock investor. And Adam Lawrence will be representing residential property today. So Adam's he's a prolific property investor, and he's an expert commentator on all things related to property and economics. If you don't already, you should definitely follow him on LinkedIn, YouTube, Facebook for his regular insights, which I love. In particular, he has an amazing weekly publication, which you should subscribe to. And it's called the Sunday Supplement, which takes a deep dive into property and economics. Adam's also a founder of Partners in Property, which is a brilliant community for property investors, which organizes property and networking events across the country. And finally, myself, I've been professionally managing funds in stocks for more than 20 years, focusing on ETFs, funds, and options. So I'll be making the case for stocks today. So why did I organize this episode? So I know most of you will have interest in all of today's asset classes. And so I know this will be relevant with hopefully lots of insights to update your investment strategy. For me, there are only two serious asset classes which deserve consideration as part of your core portfolio, and that's stocks and property. So property including Resi and commercial. Why are they the only two asset classes that should form the main part of your portfolio? Because both have a track record of inflation-beating returns over the long term, and we're talking decades and centuries, in fact. And the real test of a proper asset class, you have to ask yourself, does it generate income? And does that income grow over time? So stocks tick that box. We're essentially investing in companies whose profits grow consistently over time. And that's why share prices grow over the long term. And property generates rent, and rent grows over time. And that's why capital values grow. Now, of course, each asset class has its own unique opportunities and risks, which hopefully we're going to be covering today, I'm sure. So with that, I'm going to pass it over to Natasha. Natasha, over to you to make the case for commercial property.
Thank you so much for inviting me on this. I really appreciate it. So I am a massive advocate for commercial property, and there are real reasons why. Number one, leases typically for a longer period. We know what's going on. We can put in place leases that are landlord friendly. They make sure that we are getting an income for X amount of years, and that we can control how that income is stacked as well, which then leads me on to regular reviews of rent. At the moment, we're seeing a lot more RPI linked rent reviews, although I would say that when I do RPI linked rent reviews, we are capping and collaring them based upon the current market and what we can get out of the tenant. But also with longer commercial leases, the ones that are 5-10 years, you might have open market rent reviews if you feel that the market is going to go up at some point, in which case we always are moving our rent in line with how the market is changing. Usually we get higher rents and yields as well, and they're paid quarterly. So often that helps more with cash flow. Admittedly, over the last couple of years, we have got tenants paying on a monthly basis, but that's okay. As long as our tenants' businesses keep going and we've got businesses that really are invested in where they are and the properties that they're investing in and the properties that they are in, we see that we get rents continuously. Tenants typically cover maintenance, so they have full repairing and insuring leases by way of a service charge, or if they have the whole building, then They pay for the whole building, which means that as a commercial landlord, I make sure that all I have as expenditure is my mortgage. That's it. The tenant will pay for everything else. We've got better security with higher deposits and guarantees. If I've got a poor tenant or poor covenant, then I'm going to be looking for them to give me a higher deposit. And you get to ask for whatever deposit you feel is comfortable as long as that tenant's okay to pay it. And there are different ways in which you can get that tenant to pay a larger deposit. You could say that they can top it up every single month until X date, or you can ask them for 3 months, 6 months, 12 months up front. And then if the tenant at some point during the lease beats their revenue goals or a figure that you set and you agree with them, then you can give them the deposit back. So it's a real flexible way of doing it as opposed to Resi, where we've only got a certain amount of deposit that we can get. Easy to use forfeiture clauses. If you really want to forfeit a commercial lease, as long as there's a forfeiture clause in play, you can. There is a caveat there that the tenant can obviously apply for a release of forfeiture. But if a tenant is struggling and doesn't have any money, probably not going to happen. Then investment value, improve with better leases as well as better rents. We're in control of our investment value. Whereas residential is bricks and mortar. With commercial, I know that if I put in place a better quality tenant and I secure my rent for a longer period of time, that yield is going to come down on that property, in which case I can improve the value of the property. And that's certainly a strategy that I can do from anywhere. I don't need to be on the ground. I don't need to be anywhere in particular. I just have my spreadsheet. I can work out what's going on based upon comparable evidence, and I know what to put in place with those leases to improve the value. Cheaper stamp duty, more tax friendly, less heavily regulated. The government don't seem to be going after commercial property as much just yet. In fact, if we look back to COVID, businesses were the first thing that the government tried to prop up. They used out loads of money at businesses to help them keep going, keep paying rent, expand their businesses. I'm not saying that in the aftermath has been great for all businesses, but certainly the government has been more business friendly. And finally, it's business to business. I'm not dealing with someone living in their home. So I can actually have a professional conversation, and we are negotiating from a professional standpoint. It's not personal. It is just business.
Great. Okay. Some really good arguments there, Natasha. One other thing I would add is that commercial property you can own in your pension too. So you have some tax advantages, right? So you can in SASs and in some SIPs too. Yeah. So thanks for that. What do you think, Adam? Do you have any comments?
Very good. I might just rebut a few of those as we go along with my piece, but very fair and concise summary overall of the strengths of commercial property.
I guess the question for me, Natasha, is that there are some changes going on in the world, on the high street, the way people are working in offices, and those changes are continuing to happen, right? So they weren't just COVID related. They will continue over time. How do you deal with that? Because some high streets, lots of empty shops, a lot of offices. I know the office I work in, there are lots of empty offices there, lots of voids. How do you deal with that? How do you manage that risk?
I don't think that when you buy a property, you should have a set tenant that you're expecting to go in there. And very much the commercial property trends change every 5 years. They've changed every 5 years since I've been in the industry. What I was seeing, back in the 2008, 2009 is definitely not the tenants that we're seeing now. So you have to be open to that change. So when you go out to market with your unit, it's not, I'm just looking for sort of tenant. I'm looking for this retailer, which traditionally we used to do, and especially when the used classes were more defined. Now that they're more of an open used class, what I like to do is I go out to the market and I say, actually, what would you use this space for? I've got a blank space. It's whitewashed. It's fine. Come in, tell me how you want to use it. And allowing tenants to be more innovative with my space or my client's spaces means that we fill up these units. I do not believe that the high street is necessarily dead, but what I do believe is that people are lazy with their units. And the other thing that we're seeing is look, the UK is in problems financially. A lot of councils don't have a lot of money, but equally a lot of councils own those commercial units. And if they cannot afford to do up those commercial units when a tenant comes out because the tenant has completely walked all over them in dilapidation, they're not going to be able to afford to make that unit into a standard where anybody's going to come in and rent. I know, for example, one of mine in Bath, next door, the council cannot afford to renovate that property to open it up again. As a landlord, you need to be making sure that you are constantly looking to get that unit back into good condition when a tenant moves out. That starts when you're negotiating the lease. That starts when you put in place, hey, this is a condition I want the property back in. And then if you're not going to get that tenant put it back into shell condition, you're going to be wanting to put the money aside so that you can do it yourself. And that is how we are seeing property less. So am I worried about the high street dying? No, I'm not. What I want to do is make sure that we are giving space for tenants.
Great. Okay. Thank you, Natasha. I'm going to hand over to Adam because I think that will probably be a good transition into residential property at that stage to compare and contrast. So over to yourself, Adam.
Okay, thanks very much. And thanks to Natasha for all of that as well. I would say the real primary points behind Resi are, it's when you want something that, there's a reason why people say safe as houses, right? It's pretty boring. It's pretty vanilla. It has got a very good, not very volatile track record over time. Whereas commercial properties, just as you can create an awful lot of value with structuring the leases correctly, you can also lose an awful lot of value. And if you go back to COVID times, whereas Resi rents were still, there was a negligible difference in arrears compared to a normal year in 2020. In 2020, we saw commercial properties only collect 50% of the rents, roughly, that they were due. Luckily, commercial landlords tend to be lower geared and have more in reserve and tend to be bigger companies. But of course, that was a bit of a surprise. So you've got the low end of the risk spectrum. And in fairness as well, you've got a higher end of an effort spectrum normally as well. It's a little bit harder to add that value. You've got to fight a bit more. You're normally putting it in through refurbishment and spending £1 to create £1.50 or more's worth of value as a rule. There are also some tax benefits to doing that if you're operating within a limited company or in your personal name. So they're also worth considering. But you've got a market where since 1950, you're up nearly 8% per year over time. Some of that is front end loaded. So that I'm not suggesting property Resi goes up 7.7% every year from here on in, but it still tends to at least keep pace with RPI, which is handy. And even in the worst of the worst situations where credit is completely withdrawn, which we saw in 2008, we only saw a drop of about 15% in values. And you can make an argument that some of that was quite false. So you're looking at a very low downside for a long upside. It does generally take time in the game to realise that. But one of the old adages, you make your money on the way in. It's up to you, the strengths of the deals that you put in, and also the amount of time and effort you put in order to get those deals. It doesn't do badly as a simple, good old, find a 25% deposit, put that down against the property, sit on the property and wait. Of course, you can do better by being a bit more active and a bit more creative and putting a bit more time and effort into what you do. But you've got an option for pretty safe leverage as well. You struggle to be sensibly leveraged residential property returns, and it does what it shouldn't really be allowed to do, in that the risk, generally speaking, is quite low and the returns are quite high, which is not typical for any asset investment class. It's obviously got quite a bit to do with the fact that it has so much in terms of utility. Resi property is so useful to people because, apart from anything else, we all need roofs over our heads. And that sort of bleeds into the demand versus supply side of things. There's been a pretty large increase in the UK population over the past few years for a number of reasons. And ultimately, the house building has not ramped up. If anything, it's ramped downwards. So you've got an awful lot of pressure. You have had for nearly 10 years now, certainly 9 years, on landlords in the sector who are being taxed more than they were, pressures being put on them to leave the market. Aside from anything else, tenant demand is absolutely huge, and supply of good quality rental properties is very low. Of course, that depends on geography to an extent, but you've got you've got a demographic shift emerging where, although the birth rate is quite low at the moment in the UK, over the next 10 years, a considerable number more people will be in the 20 to 30 age bracket because of people who've already been born, and they're moving through the demographic curve, and they are your typical renters. Although, of course, you do get renters of all ages. They're your sort of target market. So you've got that. You've got a fairly quick liquidatable value. There's not many fast buyers, not as fast as a stock, should be clear managed, but you have got a liquidatable market which operates all the way from 7 days up to 180 days plus. And yet you have to compromise on sale prices in some of those situations. But you can normally move properties on through auction, for example, at sort of 85+% of their full value. So it gives you an out if you particularly need one. So it doesn't have to be completely illiquid, although liquidity is always a bit of. You've got security in your value, because apart from anything else, in a vast way that the UK these days, it tends to cost much more to build a new property than to buy one. Obviously down in the southeast, not so true, but you often see these days rebuild values, because prices have gone up so much in terms of construction costs. Rebuild values are not far away from capital values, even in more expensive parts of the UK. So it's very difficult to replace that. It's not like, for example, if you could build an office block for a couple of million quid and get it valued at 4 million, there isn't necessarily too much stopping someone else building another office block for 2 million quid and going into competition with you in that locale. Resi doesn't really have that threat to it. It's very difficult for new houses to be built, and that's part of why we've got the problems that we've got in the UK around the housing markets. Apart from anything else, you've got an inflation-friendly asset where effectively you're taking nominal debt, you're fixing it a slightly lower rate normally that you pay on commercial property, slightly better loan to value normally, which can magnify your returns on equity, which is one of the good ways you can compare asset classes where you've got to bear risk in mind as well. Of course, so some kind of risk adjustment is a good idea, but it's very favourable, and it has been very favourable in times like we've had recently of significant inflation, because it's eroded away that nominal debt. But just like Natasha said in commercial, there's rent progression over time, especially at the moment. Rent progression has been downwards in percentage terms since about 2005, but has had a massive resurgence with this wave of inflation we're going through at the moment. So inflation on side and helping you out with eroding the true value of that debt away once that's been considered. You've also got a significant opportunity at the moment in terms of the number of people seeking to exit, apart from anything else, because you've got people who will deal at prices below market value. It's not that easy to buy stocks below market value, for example. And with commercial, as Natasha correctly said, there's different ways to add value, but there's lots of Resi. And although you still have to say no to 97, 98% of what there are deals out there, and they are in reasonable volume, there's definitely at least a few bargains done at every auction I ever see on the Resi side of things. And I think, yeah, maybe I wouldn't mind having bought that at that sort of price. Of course, there's a few where you think, I don't know who's paid that price at the other end of the spectrum as well. But of course, it takes opinions to make a market and make an auction. And then the last thing I would say is there are some really classic tried and tested ways to add value in Resi. For example, 2-bedroom houses that are quite large, being converted into 3 beds, having that extra bedroom. That's worked for many years and still works today and still will continue working over the next 20 or 30 years. So converting the existing rather than building new, because of the costs of all of that, can often make quite a lot of sense. So that's probably me in a nutshell there, Manish. I think probably about 5 minutes worth. Obviously, I'm a big advocate. It allows you to use momentum, residential property, and carry on building a portfolio once you find you can tap into some good sources of deals. And I think it remains, whilst it's not necessarily the most dynamic and exciting of asset classes, it does deliver solid returns It's like a well-paying bond with a low risk is how I would the analogy that I would provide.
Great. Thanks, Adam. Yeah, look, as usual, a comprehensive kind of range of points from Adam and compelling points as well. What did you think, Natasha? Any questions, any critiques of what Adam's just said?
I think the biggest problem with residential at the moment is that it's voting fodder. A lot of Labour, you Conservatives, you see it all. They are going to always try and get behind whoever they can get votes from, but also they heavily regulate the market. Does that not worry you going forward as we see more regulation come in terms of, well, they haven't done sustainability, they're going to have to do sustainability at some point, and they keep changing utilities and how we have heating, how we run our systems? Does that not worry you a little bit in terms of the profit that can be made?
So I think probably the biggest squeeze we've had on our margins is the cost of debt, apart from anything else. And I think perversely, although I take no joy in saying this at all, but every single bit that puts off smaller landlords helps people like me and people with bigger portfolios, because it just affects that supply and demand dynamic that little bit more. So lots of rental stock is, so much is still owned by people who've got one property or two properties. The vast majority, 80+% of landlords have got between 1 and 3 properties. Those are typically people who kept a house and bought another one, or got married later in life and they already had a property and they've moved in together and things like that. Those are the people that get pushed out in reality. And those people can sell those assets into the open market. Quite happily, they are ex-owner-occupier asset. I think if you select for example, I've always been a bit of a yield chaser. Natasha, I've declared up front, and I know you look at higher yielding commercial properties to get some great double-digit returns and things like that. And that margin of insurance that you've got over and above the interest rate, even if there is a cost base associated, insulates you quite a lot. The broader sustainability point, I think, is a good one. We probably think that the new administration will bring back in requirements for EPCC and things like that. I think I've held the same view for a long time, and I've seen where the big institutions are lobbying in this department. They're lobbying for it being a government-funded scheme. We've been accessing some free grant upgrades for many years. They come in different forms all the time. I think some of them are pilot projects that don't necessarily make it through. We've had 34 properties upgraded in the last 12 months with zero cost input, with a whole variety of measures, all the way from heat pumps to cavity wall insulation and other things like that. So we've had quite a lot done. And I think the only way the sector can survive is if that's funded by the taxpayer. Unfortunate though that might be. And I think at the moment, anyone with half a brain will also be saying to the new administration, if you put more pressure on this sector at this time, more people are going to leave. We can already see from the figures of the new stock coming through, certainly that's using leverage, is very limited. Only £1 in every 12 at the moment that's being lent on residential properties being used for buy-to-let. Whereas if that really needs to be £1 in every 6 or 7 or something like that. And in the boom times, it's £1 in every 5 that's being lent. So that is just constricting the supply more and more and more. And it comes down to a government having to make, especially with a Labour ideology behind it, having to make it difficult. Ultimately, what's important to them? Is it more important that they house, that there's a supply of rental properties? Because the build-to-rent sector has built 100,000 properties in basically 10 years. And there's another couple of 100,000 in the pipeline. This is not going to make a meaningful difference. And we're so far behind with the institutional size mindset. And you've got really a sector that's quite scared of the age of our rental stock in the UK. None of these are good things. They're all structural problems for the UK to solve. But I think that gives you a lot of insurance in terms of where the cost base is and where everything else really can go. And I think probably if they do something silly around EPCs, you're more likely to make more money from the opportunities of what you'll be able to buy when people start to dispose of stock than you'll lose on having to. They're going to have to come from somewhere ultimately, in order to, so will you be able to get interest-free loans from the government if that's what you need to do? And it will just get priced into what's going on, in my opinion. So I don't spend too much time worrying about that, because I'm worried about every rumour there'd been over the last sort of 12 or 13 years. I certainly wouldn't have bought what I've bought, and I probably wouldn't get out of bed in the morning to be a bit, yeah. But I understand the point.
Yeah, I like Resi. I own Resi, and I'm not looking to sell any of my Resi property. I just think, for me, it's become a lot harder when I look at new properties out there. It's become a lot harder for things to stack up, and a lot of that is related to mortgage rates and all the rest of it. But look, there is no doubt, if you go and find a property where you can add value, you can add the extra room, which Adam mentioned, you can force value into it. For me, it's got harder because it's become a little bit more crowded, certainly in the areas I look in. I'm not a prolific property investor, other people like Adam. But if I was to go out looking for a sort of vanilla buy-to-let deal for yield and for maybe long-term capital appreciation, I'm finding it really hard for things to stack up right now. And look, apart from the fact that mortgage rates are high and your net yields aren't that great, people also don't always take into account taxes and management fees and maintenance and legals and other fees and stamp duty and all the rest of it, which really stacks up. So you have to really sort of look beyond the headline numbers. So yeah, I'm finding it really difficult to find things that stack up on a vanilla basis. I don't know if you agree, Adam. I don't know if you find the same. Is it just me, or do you have to actually put in a lot more work to get good property deals these days?
No, I think only a fool or a liar would disagree with that, Manish. There's no two ways about it. The interest rate scenario has changed things fairly dramatically. That's led to, at this end, either any of the following, really, having to do more creative deals, including payments over time and things like that, and getting involved with buying limited companies that have got portfolios in, because landlords are still keen to exit, which again opens a whole number of creative tools available in the suite to be able to purchase them. But look, at the moment, trying to buy something that's got a 5% yield is extremely difficult unless you've got a large amount of cash to throw at it. And even if you have, unless you don't use leverage at all, of course, you're in that position. But of course, your returns are not magnified by the leverage. So it becomes very difficult. A large amount of property has become not what I would call investment grade, really, at the moment. So our own volumes in terms of numbers of transactions are down. But on the flip side, what we're seeing at the moment is we're seeing vendors more realistic than they've been since before the pandemic. So you may have to accept that although the cash flow in year one might not be fantastic, you've probably got an escalating rent because of the way things are around the rental market at the moment. And you've got a significant amount of equity that's sitting on paper that, as I say, you could release or liquidate if you saw fit. So it is playing the long game sometimes. And this will depend, of course, everybody listening will have their own wants and needs in terms of how much do you want as cash flow and how much do you want as capital appreciation? Because in the same way that you would talk about accumulating units and income producing units, people can make those decisions. And at the moment, you're being forced more towards taking a longer term view. But on that subject, there's a lot of evidence at the moment that the property is well below its inflation adjusted price over the last 25 years and actually looks really cheap. Although I say I'm not expecting property to go up 7.7% a year or whatever for the next 75 years, I think we could have some years that look like that in the relatively near future. And if you've got some sensible leverage in there, those returns can really get quite interesting, I think.
Okay, thanks, Adam. Really great points. And Natasha, I don't know if you needed to chip in any further or shall I move on to stocks?
You do stocks.
Okay, perfect. So over to myself. So I like stocks. Stocks are a core part of my portfolio now. If I look at my own asset allocation, they're the biggest part of my portfolio now. Why? Because I've been adding to them over the last few years. The markets have done really well. And so overall, they've just grown, and they've just grown as a percentage of my overall. So look, stocks are a real investment. There are people out there who trade and not invest, and they don't really understand the reality of stock market investing. So stocks are a real investment. You legally own a piece of a real company, right? You're entitled to a share of its profits and dividend. And it's not speculative at all. You own companies that make real stuff that people need. So that's the first thing to say. Secondly, they're passive. They're completely passive. They're hands-free, set and forget. And really over the last couple of decades, the whole thing about index funds, the growth of index funds, the growth of ETFs, that's really been a game changer. And that now allows you to invest in an automatically diversified, automatically balanced way without really putting in any effort. It's literally is set and forget. It's simple to implement. You don't need to worry about monitoring, management, etc. Tenants, toilets, and boilers. I often say there's none of that stuff. And when you're investing in stocks, you don't need thousands or tens of thousands or hundreds of thousands. You can literally start from £100. You can buy single funds, ETFs, stocks with virtually no min. This one's really big for me because people underestimate the compounding impact of tax. So stocks can be very tax efficient. They're tax free. When you invest in your ISAs and your pensions, they have an unrivaled tax advantage in my view. And you're essentially taking free money, right? It's not often you get free money from HMRC, but they give you a free top up. Whenever you invest in your pension, contribute to your pension, you're getting free money on top of what you've invested. So that is a huge thing for me. That proven inflation beating returns over the long term, they are a compounding machine. So we're talking about returns of 8 to 12% per annum on average, nominal. And in real terms, after inflation, that's 6 to 8% in real terms. And that's not just recently, that's over the last 150 years. Okay, so we've got long-term, just like property, we have a long-term track record of proven inflation-beating returns. And actually, over the last 15 years, since the financial crisis, we've had more like 15% per annum in growth. So that's really attractive. The returns have been great. Of course, markets decline. They always do. And for me, that's an opportunity. I rub my hands in glee whenever markets decline because I'm pound cost averaging all the time. And that allows me to buy more shares, more units of what I like anyway. So you get the opportunity to buy things when they're on sale. There's never been a permanent loss, right? If you look back over the history of stock market history, there's been all sorts of things going on, but there's never, ever been a permanent loss, especially if you invest in a diversified way. Markets always recover. And we know that by looking at 150 years plus of history. So we've been through wars, been through famines, pandemics, crisis after crisis, existential threats like World War I, World War II, right? And markets have always come through it. And we're talking in real terms have come through it and have continued to make new highs. Stocks are liquid. You can buy something today and sell it tomorrow and get your money the day after. And here's another big thing for me. So not many people are aware that stocks are a really rich source of recurring income. So we're talking dividends. You can get really decent levels of income through certain blue chip, high quality blue chip stocks. So we're talking dividends 4, 6, 7% per annum on some stocks. Of course, you have to be selective. And you can also get income through REITs, real estate investment trusts, so investing in property through the stock markets. Again, you have to be selective because they're not all great, so you have to do your due diligence, but we're talking income levels of 3, 4, 5, up to 8% per annum. And the final thing is, which I do, a lot of my investors invest in options alongside our stock portfolio. So options give you an opportunity to earn 1 to 3% per month. Yeah, per month. And this is options. A lot of people feel they're high risk, but actually a safer way to invest in stocks than actually doing it the conventional way. Those are my points. And the final thing I would say is I think stocks are the only asset class out there where you virtually keep everything you made. If you do it properly, if you're not paying away too much in fees, you can keep most of your gains, and there's no taxes if done properly. There's no high management fees if done properly. There's no maintenance, there's no legal fees, etc., etc. So if you do it in the right wrappers, in the right setup, you basically keep everything you made. So yeah, that's my case on stocks, and happy to hear questions, critiques, etc.
The one thing I would say about stocks is they always seem so confusing to get into. And I think that's a barrier to entry for most people, is that it sounds great. And, all these rich people and people who make a lot of money have stocks and shares accounts. For the person just starting out, that's really confusing. And that would probably, it should be taught at school, honestly. It should be taught at school. I'm a firm believer in that. But that's where I think that stocks and shares falls down, because it is easy to get into. If you have £50, £100, great. But where do you even start? How do you know where to start? Everybody tells you the best time to invest was when you were 16, 17, 18. Okay, but where, how, why? Whereas property is something that you're always expected to get into, especially residential. That's why people get into residential. It's easy. We know exactly really the ropes. And you know that if you haven't done it before, there's plenty of people around who can call you through it. Whereas stocks and shares, you go on the internet and you find the stocks and shares account, and sometimes they look dodgy as hell. Hey, that would be my critique of it. What would you say?
I think, look, it's a fair point, and a lot of what you've said is almost deliberately created by the financial industry, because what they want things to sound complicated. So what do? You invest through them, you pay them fees, right? And it's not. The great thing about stocks, you don't need to be rich, you don't need to have experience, you don't need to have any expertise. They are one of the simplest ways to invest. It's just that people, they don't appreciate that. And it's a fair point, Natasha. And I'm trying to do my bit to make people aware that actually they're super simple. And actually the people amongst my investors, the people who achieve the best returns in options, for example, they've only been doing it for a year, 2 years. I've been doing this for 20 years. I'm a little bit more conservative, but there is no barrier to entry in terms of performing well just because you have more experience. I think the key thing is what you've said is you just need to get over this sort of the perception of complexity, because it's not as complex as most people think, but it's a fair point. Adam, did you have anything?
I think I would probably just highlight that, firstly, the volatility that it can be in the shorter term, especially with trading things like options. So you do need to have the right sort of disposition, and you do have to, as you've alluded to there, be able to have the potential to get quite a bit higher returns because of that volatility. Not everyone is suited to that, of course, and people need to be honest with themselves about their risk profiles and things like that. Of course they do. I also thought you were a little bit cheeky to appropriate the ISA and the pension as only being in the stocks and shares category, because we did already talk about commercial via SIPs and SATSs. And of course, you have got things like the IF ISAs and things like that, the intelligent finance ones that do enable you to do all sorts. And there are also ways by both genuinely diverse commercial vehicles to invest SaaS money in Resi. And of course, if you've got companies you can do loan backs to, then you can loan back and use funds for Resi, although you can't use 100% of your pension fund for that. And you can't use your ISA funds for that. I'm a big advocate of the tax shields that you've outlined there. Absolutely. I think everybody should use them. But also I'm acutely aware that they've also got a ceiling. Once you've gone up to your ISA thresholds or your pension contribution thresholds or whatever, there is an element of what then and how do you do it. And I think that the strength of probably all three of the things that we've all discussed today is also that a lot of the tax gets deferred and is only crystallized, assuming the tax is in the capital gain on the stock rather than the dividend. Of course, there's a bit of both. The same goes for Resi and commercial. There's going to be tax on the rents that come in one way or another, depending on the vehicle in which you're holding them in. But some of the big gains can at least be deferred until the sale of the asset, which helps you compound and gives us all an advantage over certain other things that are out there in the market, in the big investing wide world. And to be fair to you as well, I think Natasha raised a good point. But let's face it, Natasha, there's sharks swimming in all of our respective waters. We've all got to be careful about what we look up on the internet about commercial property, residential property, or stocks and shares. I think that point probably is fairly level to all three of us, to be honest.
Yeah, that's a great point, and worth mentioning, absolutely. So people need to, I think the key thing there really is don't fall for everything, and investors, our shortcut as human beings is to see what other people are doing and saying, and we almost fall for the marketing sometimes. So I think Adam's is make sure you do your own due diligence, know your own risk profiles, know what you want to achieve, and take it from there. Don't buy other people's products just because they're making a good job in terms of marketing it. Know what you want first. I think that's the key thing. So look, we've heard some great arguments from everyone. I've really enjoyed it. I've learned a few things here and it's been great. And personally, I own all three asset classes and I know both Adam and Natasha own all three. So we were partially being devil's advocate here, but I think that works well. I think the key thing for me is diversification is key. And when you diversify, it mitigates asset specific risks from all three. So the key question is not necessarily what to own. It's really what portion of your portfolio to allocate to each one, given your personal risk profiles, given what your personal objectives are, and also where your expertise is, right? And how much time and effort you want to put into it. So I would say take a look at your own portfolio. And if you're too heavy or dominant in one, maybe think about diversifying, think about what you want to achieve and take it from there. But I think there's merit in all three asset classes we mentioned today. I don't know if you guys have any sort of concluding remarks before we wrap it up for today.
I'd agree with your sentiment. I've taken the viewpoint that I buy commercial property and only little commercial property. So, for example, I bought a telephone box and I rent it out as retail. And that money then goes into stocks and shares, so constantly compounding the income that's coming in. And so I spread my risk based upon, do I expect at the moment to get a huge amount out of my pension? No, it's years off and years off. And I've put that through my other assets as well. So I can have a little bit more fun with that, but other people aren't going to be able to. So it's making that decision as to where am I happy to take that higher risk and where am I happy to actually, I want low risk. I just want that money coming in and compounding for me. If you make those decisions, then that means that you have got a portfolio that ultimately one thing isn't doing quite so well. Another thing will be doing quite so well. And that's all about balancing your portfolio.
Absolutely. The magic of diversification. Right. Adam, and anything to add to that or?
Very much endorse what you've both just said. And I would just probably reiterate the point slightly as well, that yes, it is very much about diversification. And it's also about your answers to the marshmallow test or jam today or jam tomorrow. You're also going to balance income producing and capital growth on one side of the fence than the other. So you can achieve that through your diversification as well. It's all very well deferring everything, but if you defer everything, you can't eat tomorrow if you're not bringing in another source of income. So it's balancing your time, balancing your risk, balancing all of that, balancing your effort ultimately. And that's what true diversification and true balance really looks like. And I think that's what everybody should be striving towards. And I'm not there yet, but I'm certainly still striving towards it every day. But I think I very much agree with what you both said as well. Great summary.
Yeah, great points. Great points. Again, I just want to say thank you, guys. I know your schedules were really busy, and I feel privileged to have had both of you on this today. Lots of value for our listeners and our viewers. So again, thanks very much. Where can people find you guys, Adam? If people want to follow you, find you, how can they find you?
Yeah, so Adam Lawrence on LinkedIn. Drop me a follow on there. And as you already kindly alluded to, my newsletter that comes out on a Sunday and my Sunday supplement. Also on YouTube. So my channel is called Proponomics with Adam Lawrence. So property and economics mashed together. There's a few hundred videos on there now, some evergreen ones and some newsworthy ones as well. So well worth a look, and drop me a subscribe on YouTube as well. That'd be great.
Great. And Natasha, where can people find you?
You can head to my website, ncrealestate.co.uk. You can follow me on Instagram, which is at ncrealestatелtd. Or you can listen to my podcast, The Honest Property Investment Podcast, or email me, Natasha at ncrealestate.co.uk.
Fantastic. And guys, if you enjoyed today, if you found value, please do and subscribe and follow the podcast. Until next time, see you later.